So welcome to the video lecture on financial aspects of construction project. The contents of this video lecture are means of finance, project balance sheet, cash flow statement, and also profit and loss statement. So we'll be seeing in the first thing the sources of finance. So the parameter for choosing the sources of fund. So these depend upon the cost of source, that is we can call it as the interest rate, then tenure, for how many years we are requiring that, financial condition prevalent in the economy, then risk profile of both the company as well as the industry in which the company operates. So these are some of the parameters for choosing or selecting the sources of the fund. The types of sources of finance can be spontaneous, also it can be the negotiated. The next type of classification can be according to the term, that is years of the finance. So broadly we can classify them into short-term finance and long-term finance. So in between that we can also see that there can be a medium-term finance too over there. So first one is the short-term finance. So short-term finance are required primarily to meet the working capital requirements of a particular company. The focus is on maintaining the liquidity at a reasonable cost. So these are the some of the types of the short-term finance. Let us see them one by one. So the first can be the working capital finance. The next can be the trade credit. The next type of short-term finance can be intercorporate deposit. Then we can see factoring, and then we can see the next type of short-term finance as the commercial paper. So let us see them one by one. So first one is the working capital finance by commercial banks. So the commercial banks grants short-term finance to business firms, which is known as the bank credit. So the bank credit may be granted in the following ways. First one can be the cash credit and second can be the overdraft. So these are the working capital finance by the commercial banks. The next is the trade credit. So trade credit represents credit granted by the suppliers of the good, etc., as an incident of the sale. So the merits and demerits of the trade credit can be, so the merits can be credit for the purpose of the raw material or finished goods. So for example, in the construction side, we can take the cement on the while doing the construction of a slab, credit for 3-4 days, and after the slab we can make the payment of this. So such type of credit is known as the trade credit. So merit can be no security is being required for such type of the short-term finance, and also no interest payable is also there. The demerits can be the, it is very much less flexible over here. So we cannot apply more number of units in this. Next, short-term finance can be the intercorporate deposits. So a deposit made by one company to another company is called as the intercorporate deposit. For example, a company such as suppose Reliance is depositing, Reliance Jio is depositing money into Vodafone Idea. So this type of deposit, so these are making the deposit over here. So this type of short-term finance is known as the intercorporate deposit over here. So it is generally for working capital funding and is for a period not exceeding 6 months. The next type of short-term finance can be factoring. So factoring is an agreement in which receivable arising out of sale are sold by a firm to the factor, that is a financial intermediary. Commercial paper. Next type of short-term finance is the commercial paper. So commercial paper is an unsecured money market instrument issued in the form of a promissory note. So it is a money market security issued or sold by the large corporations to obtain funds to meet short-term debt obligations, for example, payroll or etc., and is backed only by an issuing bank or corporation's promise to pay the face amount on maturity date specified on that note. Since it is not backed by a collateral, only firms with excellent credit rating from a recognized credit rating agency will be able to sell their commercial paper at a reasonable price. So commercial paper is usually sold at a discount from the face value and generally carries lower interest repayment rates than bonds due to shorter maturities of the commercial paper. So typically, the longer the maturity on a note, the higher the interest rate the issuing institution pays. So this is the example, or this is known as the commercial paper. So here we can see an general electric uh, specimen copy of an commercial paper over here. Now the advantages and disadvantages of this will be seen. So the advantages can be high credit ratings will be there. Then we can have flexibility in the payment. It provides exit options, and the disadvantages of this method or this type of short-term finance can be limited applicability. So these were the various short-term finance. So now let us move to the next type of finance, that is the intermediary of the short-term finance and the long-term finance, that is the medium-term finance. So medium-term finance is defined as a money raised for a period for 1 to 5 years. The medium-term funds are required by a business mostly for the repairs and modernizations of the machinery. So whenever we are requiring a money for 1 to 5 years, and especially for specific reasons for repairs, etc., and modernization of machineries, we are taking, or the company takes, the medium-term finance. Now next we'll be seeing the long-term finance modes. So let us see them one by one. Long-term finance modes. So the first can be the shares of a company. Then next can be the debentures. Then debt instruments. Then retained earnings, depository receipts or schemes, venture capital, and securitization. So we'll be seeing one of them one by one, all of them, these long-term finances. So first one is the shares. The capital of company in this method is divided into shares. So each share forms a unit of ownership and is offered for sale so as to raise the capital for the company. Now the shares can be of the two types. It can be of the equity shares and it can be of the preference or preferential shares. Preferential shares are those shares which are having some dividend being mentioned specifically, whereas equity, there are no such payment or the dividend or anything being mentioned in the prior terms. Now the two measures we have seen that the two major types of shares, that is the ordinary shares or common stock, which entitle the shareholder to share in the earnings of the company as and when they occur, and to vote at the company's annual general meetings and other official meetings. And the second one is the preferential shares, which entitle the shareholder to some fixed periodic income, that is interest, but generally do not give him or her the voting rights. So these are the two different types of shares, and these are the differences between the ordinary shares and the preferential shares or the preference shares. The next type is the debentures. So it is a document containing the acknowledgement of indebtedness issued by a company and giving an undertaking to repay the debt at a specified date. So debentures are a medium to a long-term investment that allows companies to raise fund or finance by borrowing money from the citizens. They are of the debt financing. A company issues debentures in exchange for money. This debenture is basically a promissory note stating that the company will return the principal amount along with the percentage of the principal amount as on monthly interest to the issuer at the future date. So in our Indian terms, we can call them as the bonds. For example, if a debenture of 50,000 rupees is issued with a yearly interest rate of 10% and a maturity date of 10 years, the debenture holder would receive an annual dividend of rupees 5,000, that is the 10%, for the 10 years. And upon the maturity of the debenture holder will receive the original amount, that is the 50,000 back also. So this is the advantage to both the company as the debenture holder also. So this is a typical debenture of a company, that is William and Sugg company. So here we can see that this is a pretty old debenture over here. Now see here we can see the date of 31st December of 1897 over here. So in this, which is the mentioned that issue of a series of mortgage debentures of £100 each and 50 each respectively, limited to a sum of £15, and it is redeemable at par on this date. So bearing interest at the rate of 5%, which is being mentioned per annum, payable half yearly on 1st January and 1st July in each year until the respective principal sums shall be paid. So interest of accruing from the date of payment to the 30th June will be paid the next July next. Okay, so this is a typical debenture form, or we can call it as a bond also. The next type of long-term finance is the new debt instrument. It is a debt instrument, or a debt instrument is a paper or electronic obligation that enables the issuing party to raise funds by promising to repay a lender in according with the terms of the contract. It is a document that serves as a legally enforceable evidence of a debt and the promise of its timely repayment. Types of debt instruments include notes, bonds, certificates, mortgages, leases, or other agreements between a lender and a borrower. So the new debt instrument can be zero interest bond, or it can be also a convertible debenture. So let us see them one by one. A zero interest bond is a debt security that doesn't pay interest, but it is traded at a deep discount, rendering profit at maturity when the bond is redeemed for its full face value, also known as accrual bond. The zero interest bond holders gain on the difference between what they pay for the bond and the amount they will receive at the maturity. Zero interest bonds are purchased at large discount, known as a deep discount, to the face value of the bond. In other words, a zero interest bond gains from the difference between the purchase price and the face value. Now we'll be seeing the next is convertible debenture. A convertible debenture is a type of loan issued by a company that can be converted into stock by the holder and under certain circumstances the issuer of the bond. By adding the convertibility option, the issuer pays a lower interest rate on the loan compared to if there was no option to convert it. These instruments are used by companies to obtain the capital they need to grow or maintain the businesses. The next type of the long-term finance is the retained earnings. So retained earnings means that part of the trading profit which is not being distributed in the form of dividends but retained by the directors for future expansion of the company. Retained earnings referred to as the percentage of the net earnings not paid out as the dividends but retained by the company to be reinvested in its core business or to pay debt. It is recorded under the shareholders' equity on the balance sheet. So the merits and demerits of the retained earnings. So the merit is it is the ready available to the company. It is very much cheaper than the external equity, and there is no ownership dilution by using this retained earnings. So the demerits is the limited finance is being there over. The next type of long-term finance is the depository receipts. So a depository receipt is a negotiable financial instrument. That is, it can be a real or a virtual document representing a legal agreement issued by a bank to represent a foreign company's publicly traded securities. A depository receipt trades on a local stock exchange, but a custodian bank in the foreign country holds the actual shares. So there can be two, three types of the depository receipts. It can be global depository receipts, that is GDRs. It can be American depository receipts, that is ADRs, and it can be Indian depository receipts, that is IDRs. So let us understand them one by one. So GDRs, it is a negotiable certificate held in the bank of one country representing the number of shares traded on the exchange of the another country. Whereas ADR, that is American depository receipt, it allows US investors to buy the shares of the ADS companies, that is the American depository securities companies, without the cost of investing directly in foreign stock exchange. Whereas IDRs, it allows foreign companies to raise the funds from the Indian market. So two common forms of depository receipts are the American depository receipt and global depository receipt. And ADR is listed and traded on the exchanges based in the United States, while a GDR, that is global depository receipt, can be traded on non-US markets such as London, Singapore, etc., etc. When a foreign listed company wants to create a depository receipt abroad, it follows a standard process. The firm will likely to hire a financial advisor to help it in navigate the regulations, and will then select a domestic custodian bank. A broker in the target company will purchase shares of the firm in the country where the firm is located, and then domestic bank will register the shares on behalf of the broker. The bank then issues the depository receipt to the broker. The broker can have the shares listed on the local exchange. such as the New York uh, Stock Exchange as an ADR, that is American Depository Receipt. So, for example, a firm based in Kenya looking to list shares in US through an ADR will pick a Kenyan bank to serve as a custodian firm of the firm share. Once the bank is selected, the firm will decide how many shares will be represented by the depository receipt, referred to as the depository receipt ratio, and will find an American broker willing to purchase the shares to be held by the custodian bank. Once the bank issues depository receipts, the American broker can sell those shares domestically. The next type of long-term capital is the venture capital. So venture capital is the money provided by investors to startup firms and small businesses with perceived long-term growth potential. So this is a very important source of funding for startups that do not have access to the capital market. It typically entails high risk for the investor, but it has the potential for above average returns. Most venture capital comes from a group of wealthy investors, investment banks, and other financial institutions that pool such investments on or partnerships. This form of raising capital is popular among the new companies or ventures with limited operating history, which cannot raise funds by issuing debt. The downside for entrepreneurs is that venture capitalists usually get a say in the company's decision in addition to a portion of the equity. Now, the last one we'll be seeing is the securitization. So, securitization is a process in which illiquid assets are pooled into marketable securities that can be sold to the investors. The advantages the advantage of securitization can be it reduces the asset liability mismatch. It also locks in the profit, and there is a liquidity over there. Disadvantage is that it is having a high cost. There is a limitation, size limitation is there, and also it is very risky. Now we'll be seeing the next part of this video lecture, that is the cash flow statement. The cash flow statement's primary purpose is to provide information regarding a company's cash receipt and cash payment. That is, a company is getting cash from which sources and it is paying to which sources. Okay. The cash flow is determined by looking at three components by which cash enters and leaves a company. That is through three criteria or parameters, that is core operations, investing, and financing. The cash flow statement was previously known as the flow of cash statement. The cash flow statement reflects a firm's liquidity. So cash flow statement is the statement that tells about the inflows and outflows of the company coming from operating activities, financing activities, and investing activities. So the cash flow statement is partitioned into three segments, that is cash flow resulting from operating activities, investing activities, and financing activities. The money coming into business is called as the cash inflow, and the money going out from the business is called as the cash outflow. Now we'll be seeing them one by one. So the classification of this statement on these three activities, that is operation activities or the operating activities, investment activities, and financing activities. So operating activities, the cash generated from companies' daily operating activities. Operating activities are those which produce either a revenue or are the direct cost of the producing a product or a service. Investing activities are the activities which include buying and selling in non-current assets which will be used to generate revenues over a long period of time. And then financing activities can be borrowing and repaying money, issuing stock or equity, and paying the dividends. So let us see the operating activities from where it is being done. It is done through sales, it is done through manufacturing, purchasing, administration, compliance with the government regulations. Investing activities can be purchase and sale of properties, plant and equipment, purchase and sale of stock of other companies. Financing activities can be issuing and repurchasing of a firm's own stock, borrowing and repayment of loans, payment of dividends. So let us see them one by one. So the inflows for the operating activities can be cash received from the customers, dividends and interest received through the investments, and outflows can be cash paid for the purchase of goods for resale and services, that is electricity, etc., salaries and wages of the staff, income taxes, interest on liabilities. So this can be the outflows of the cash flow to the operating activities. Next can be the typical activity affecting cash. So the cash received from sale of property, that is through investing activities, can be sale of property, plant and equipment, sale of securities that are not cash equivalent, collection of loans. Next can be the cash paid for purchase of property, plant and equipment, purchase of securities that are not cash equivalents, and a loan to others. So the next type of activities can be the financing activities, that is cash received from borrowing cash from the creditors, issuing stocks to owners, issuing debt securities, and cash paid for repayment of the amounts borrowed, repurchase of equity shares, including treasury stock, and payment of dividends. Now let us see the balance sheet. So the balance sheet as a financial statement. So it is in balance sheet is a financial snapshot also. So it lists the assets and liabilities of a business on a particular day. In India, generally, we are taking that on the 31st March. Basic principles of the balance sheet are: most businesses borrow money to help them to operate. A balance sheet has a special section called as the liabilities for this. This shows how much money has been borrowed or invested and where it came from. The term balance means that all money invested or borrowed must be accounted for in another section called as the assets. Now the assets can be classified into fixed assets, that is, these are the assets that the business owns. They will keep these assets for several years, so they are called as the fixed assets. Examples can be buildings, machinery, vehicles. Current assets. So the current assets, that means the asset will not stay in the business for long, or it will be less than 1 year. So materials, the examples can be materials, debtors money, money in the bank, and petty cash. And now what are the liabilities? Liabilities also include the capital and reserves. So what is capital? The share capital is the money which shareholders have invested in the business, and reserves are the profit which have been accumulated for the previous years and which has been kept to finance for future developments. So profit and loss is equal to the money kept back from the current year's profits. The current liabilities, the amount of money that a business owes other people and other businesses. So liabilities are the current because the amount owed can vary from one day to the next year, and they must be paid back within a year. Long-term liabilities, these are the debts needed paying back in future, that is more than 1 year. So that can be long-term loans and the mortgages. So net assets can be the assets, that is current and fixed, minus the liabilities, that is current and fixed. Last part of this lecture we'll be seeing, that is the profit and loss account. So it is the summary of the revenue earned and the expenses incurred which ultimately results in profit or loss of a company. So there is no defined format in the law for this. So operating income should be equal to the sales or revenue, and not operating operating income or revenue is equal to the other income out of the sale, investments, interest, commission, and the discount. Hence, operating profit is a yardstick for operating profit of the company. So, operating profit is equal to sales revenue minus the operating cost. So, what is the gross sales? Gross sales include excise duty to be charged to the customer, central sales tax, or now we are having the VAT, that is value added tax. So the gross sales appears in a profit and loss account, comprises of all the above part for the basic net price. So net sales is the sales figure excluding all the factors explained above. So cost of production, this is the cost incurred right from the procurement of the raw material to the finished goods. For example, in a garment firm, following cost is incurred while production: the cost of raw material, cloth, buttons, canvas, hooks, zips, etc. Maintenance of the sewing machines, payment of wages to the workers, power charges, washing, ironing, packaging, etc. Cost of production excluding selling and administrative expenses and internal costs. So selling and general administrative expenses, these are required for maintaining the office staff and administration and accounting, marketing effort, payment of salaries for marketing personnel. All expenses which are not directly connected to the manufacturing are classified as selling or general expenses. Cost of goods sold is the all manufacturing cost expenses and adjustments for opening and closing stock. So cost of goods sold is equal to opening stock plus purchases plus manufacturing expenses minus the closing stock. Gross profit is arrived deducting the figure of cost of the goods sold from the sales figure. That is, gross profit is equal to sales minus cost of goods sold. So this is a typical example of the income statement. Here we can see the gross profit. Here we can see profit before tax and profit for the period over here for the 2 consecutive years over here. So thank you very much. Hope you have understood this.